Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. I've got a lot of things that I want to show you guys in this video. We're going to talk about the housing market and how that is currently predicting a grim economic outlook looking forward. What we're witnessing in the housing market right now is quite unprecedented, and I think a lot of people are underestimating how much that's going to impact the economy. It's going to impact the financial markets. And I also want to talk about this rally and the odds of it being sustainable in the near term. I've got quite a few very interesting charts to show you regarding that. If you enjoyed this video, don't forget to smash that like button. Also subscribe. If you haven't already, you want to stay up to date, you want to find opportunities in the market. Now, without further ado, let's get right into it. Now, unless you live under a rock, you'll know that since 2009, we've been in a huge bull market on equities in the stock market, but also in the housing market. The housing market since 2009 has been incredibly strong, and that's been one of the big features throughout the last 10 years, and it has been contributing to a lot of the economic strength that's been driving the market higher over the past 10 years, right? As people see the value of their homes go up in the United States, they feel like they are richer, and so they feel like they can increase their spending elsewhere. Now, the easy money that we've had from the Federal Reserve since 2009 that has deliberately kept rates near zero most of the time between 2009 and 2021 propelled the housing market into what you could argue is a bubble, a price bubble, and not necessarily a credit bubble like 2008. We don't have evidence of real excess risk-taking when it comes to the mortgage debt market that drove the credit bubble leading to the global financial crisis. But nonetheless, a big part of the economic environment that we've had since 2009 has been a story of rising home prices, people feeling richer because the value of their homes goes up. And again, that's been driven by monetary policy. The Fed basically controls the housing market. The Fed has a huge impact on mortgage rates, and mortgage rates basically leads home sales, right? You can see that on this chart, mortgage rates against home sales. They basically go together most of the time. As mortgage rates go up, while home sales go down. You can see this is reversed. So when this black line goes up, it means sales are going down. And that's exactly what has been happening more recently. You see mortgage rates have been going up. Well, existing home sales have been collapsing more recently. Now, we found that home sales lead SP 500 earnings. As we were talking about earlier, as people see the value of their homes go up, a lot of demand for housing, that black line goes up. People see the value of their homes go up, and so they increase their spending, and that eventually feeds into SP 500 earnings, that blue line here. And the relationship is around 10 months. When you see a big decline in the housing market like we did right here, right? In 2007, the housing market was collapsing all the way till the first quarter of 2008. The housing market was collapsing throughout this entire period, which basically corresponds to this entire period right here. So this topping pattern in 2008, this topping pattern on the stock market that was forming, that was happening as the housing market was absolutely collapsing right here, right? And you can see that in the home builders index that was significantly underperforming the market throughout the beginning of 2008. And then the economy gave in and the market actually crashed around a year later. That's what this chart shows. It shows when you have weakness in the housing market, eventually you see that feed into SP 500 earnings, which takes the market lower. Now, of course, you can see what has been happening to the housing market more recently. Home sales have been absolutely collapsing. So housing, as Stanley Druckenmiller has often said in the past, housing is a major leading indicator of the economy. And so if housing is going down, if housing is collapsing, don't expect the economy to be strong, because that is highly unlikely unless you get a major pivot from the Federal Reserve. They can pause their rate hikes, and that's what's been driving this rally here, but they're not going to be cutting rates anytime soon, leading to any type of strength in the housing market. So that's the macro backdrop. It's economic weakness that's in front of us. Earnings are set to decline. Now, perhaps it's going to take a little bit longer. We are seeing some economic strength here in the data more recently. But the general direction of earnings, reported earnings, right? Not forward earnings, because forward earnings is what analysts estimate earnings to be. And analysts are rarely spot on. We're looking here at trailing earnings, so reported earnings. They're going to be going down. They are going to be going negative. So why has the market been rallying here? Because a lot of people are getting excited about a Federal Reserve pivot. Right? And this is something we've been highlighting, that this was coming, right? Every time you get a pivot or a pause well, you get a rally in the market, right? In 2006, you had a pivot right here. You got a rally in the market. In 2000, right? It doesn't look like you had any type of rally in the market. It was right here in May, but you did get a multi-month rally here all the way to August. Between May 2000 and August of 2000, so multiple months where the market was moving higher because the Fed was pausing its hiking cycle. You've got time and time again, Fed pivot, well, the market rallies. The problem is that if we zoom in and we take a look at what the bond market has been saying, the bond market has not been in agreement with the stock market, right? This is the inverse of the 10-year yield. We've taken a look at this many times on this channel before. So when this orange line is going down, it means rates are rising, and the bond market essentially expects the Fed to remain tight. And the bond market gets it right a lot, right? We had that in August. We had that in March during this rally where the market was getting excited about a Fed pivot here, but the bond market was saying, nope, we're seeing more tightening ahead of us. And that's exactly what's been happening here over the past couple of months. Ever since the 31st of January here, you had the market continue moving higher and the bond market saying, nope, we're going in the other direction. The Fed wants to tighten. This rally likely doesn't have legs. So the bond market is telling us that the Fed isn't going to pivot as early as the market thinks it's going to pivot. And behind that, you have a macro backdrop where you're actually going to start seeing earnings weaken throughout the next 10 months. These are all things that we've been talking about for the past couple of weeks on gameoftrades.net. SP 500 not pricing contracting earnings and higher yields, why the recent bullish breadth signals are likely to disappoint. This is a very interesting piece for people that are a little bit more curious regarding that we've seen a lot of strength in the market. Well, in this piece, we actually highlight why they're more likely to fail this time around than throughout history. And then, of course, we added some portfolio hedges to our portfolio at gameoftrades.net to protect us against these developments that we're seeing right now. Booking profits on our winning stocks, adding to cash, and getting exposure to volatility on the SP 500, which has been bouncing off this beautiful, beautiful line of support here. 1, 2, 3, 4 reactions. And so our goal here during this rally that we've had since October was that when the VIX reached this trend line, we would want to protect our members against the possibility of volatility rising by gaining exposure to the VIX, even if we still have some long positions on US equities. This was a high probability entry zone for us with very little risk and lots of potential reward, which seems to currently be playing out right now. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, again, don't forget to smash the like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.